Ever feel like trying to make sense of income tax is like untangling a huge knot? You're definitely not alone.
Hmm.
And with the proposed changes in the Finance Bill 2025, well, things are certainly getting a shakeup.
That's right. We're going to dig into a really key piece of legislation today, the Finance Bill 2025. Specifically, we're zeroing in on Part 2.
Right, the income tax part.
Exactly. It's all about income tax and the proposed amendments within it. And our main source here is the official Kenya Gazette supplement, the one dated May 6th, 2025.
Okay. And while that whole bill is massive, our focus today, our mission is clear, right? We're just unpacking the income tax proposal.
All right.
We want to make these potential changes, understandable for you, the listener, and highlight what you really need to know. We'll try to avoid getting lost in all the jargon.
Think of this as your guide, your shortcut to understanding the main income tax changes that might be coming. We'll break down what's being proposed section by section in the Income Tax Act and talk about what these shifts could actually mean in practice.
Okay, let's get into it then. Part 2 of the Finance Bill 2025. It's all about tweaking the current Income Tax Act. And the first thing they seem to be looking at is definitions, the very foundation.
Precisely. Section 2, which is basically the dictionary for the Income Tax Act, is up for several revisions. Some definitions are being amended, others deleted entirely.
Okay, like debenture. Now, for most of us, that's basically an IOU, right? A formal debt document.
Essentially, yes.
And the proposal is to remove a specific phrase from its definition they want to take out. And, for the purposes of paragraphs D&E of Section 7.1 of this Act, includes any loan or loan stock, whether secured or unsecured. Why does removing that bit matter?
Well, what's interesting is how this might refine what counts as a debenture, specifically when you're looking at deducting interest under those particular subsections, 7.1D and E.
Ah, okay.
It could, clarify which types of financial agreements are treated strictly as debentures for those specific tax deduction purposes. It might affect how companies structure their borrowing.
Right, subtle
That's
but
right.
potentially significant. Okay, what else? Individual retirement fund. The definition is losing the phrase subject to the income tax retirement benefit rules.
Yes.
What might that imply? Fewer rules or different rules?
It's like you have the main act and then these separate detailed rules. Removing that phrase might suggest integrating some of those specifics more directly into the main act itself.
So potentially simplifying where you find the rules.
Could be. Or maybe adjusting how those benefits are treated for income tax overall. It points towards a potential shift in the regulatory approach.
Now, this one sounds very current. The definition of royalty is getting an addition
Mm-hmm.
they want to add. It includes the distribution of software where regular payments are made for the use of the software through the distributor right after support fees. This feels very targeted at, software subscriptions.
Exactly. Software as a service, subscription models. That's how so much business is done now. This proposed change explicitly brings income from that model, regular payments for software use, via a distributor under the royalty definition for tax.
So, clearer tax implications for software companies, distributors, anyone in that chain.
Definitely. It clarifies their tax position in Kenya.
Okay, but some definitions are just gone. Compensating tax, tribunal, and venture company are proposed for deletion. What did those even cover?
Well, compensating tax, often related to tax paid when a company distributes profits after receiving certain tax benefits. The tribunal likely refers to a specific tax dispute resolution body,
Right.
and venture company was tied to tax incentives for, investing in new or risky businesses.
So removing them might mean those specific mechanisms are changing or maybe being handled differently elsewhere in the law.
That's the likely implication, yes. Either the concepts are being phased out or absorbed into other frameworks.
Okay, probably the biggest definition change, though, seems to be related person. The old one is out, new one is in, and it sounds broader.
It does seem significantly broader. The new definition really expands the net. It's not just about direct control or ownership anymore.
How so?
It now includes anyone who participates, directly or indirectly, in the management, control, or capital of both businesses being considered.
Okay.
And importantly, it also ropes in individuals involved in managing or controlling both businesses if they're also linked by family ties, marriage, blood, affinity, especially if the businesses are also involved in the individual's own business dealings.
Wow. Okay, that's
Yeah.
a lot of potential connections. And it mentions deleting the old subsection 2, which probably gave more context. Why is getting this related person definition right so crucial for tax?
It's absolutely fundamental, especially for transfer pricing.
Making sure related companies charge each other fair prices.
Exactly. preventing profit shifting to low-tax places by manipulating prices between related entities. This wider definition aims to tighten those anti-avoidance rules, making it harder to structure around them.
Makes sense. Okay, moving away from definitions. Section 5 deals with monetary thresholds, and one of these numbers is jumping up.
That's right. The proviso to subsection 2, the current threshold is 2,000 shillings. The proposal is to change that to 10,000 shillings.
That's a five-fold increase.
It is.
Now, we don't know the exact rule tied to that subsection offhand, but raising a threshold like that usually means fewer things trigger the rule, or it applies differently.
Generally, yes. It changes the point at which that specific provision kicks in. Adjusting these thresholds can really alter the practical application of certain tax rules, impacting who qualifies for something or when an obligation arises.
Okay, let's talk about personal reliefs then under Section 8. This is something that affects individuals directly. What's happening there?
Couple of things. First, a language update. The word husband in subsection 1 is proposed to be replaced with spouse.
Good. More inclusive.
Yes, it reflects modern family structures better. But the bigger change seems to be the deletion of several whole subsections.
Which ones?
Subsections 4, 5, 6, 7, 9, and 9A. They're all proposed for deletion.
That sounds like quite a few potential reliefs being removed.
It certainly suggests a significant reduction or streamlining of the available personal reliefs that taxpayers could previously claim to lower their taxable income. Without the specifics of each subsection here, the overall direction seems to be towards fewer individual tax breaks under this section.
Right. Okay. Section 10, this lists what counts as taxable income, and it looks like 2 new items are being added.
Correct. They propose adding 2 new paragraphs right after the existing ones.
Yeah.
Supply of goods to a public entity and sale of scrap.
So money earned from selling goods to government bodies or from selling scrap metal, for example,
Yes.
is now going to be explicitly listed as taxable income, removing any doubt.
Precisely. It brings those specific income streams clearly under the income tax net, formalizing the tax obligation for those types of transactions.
Okay. Back to the digital world for a moment. Section 12E, taxing the digital economy. There's a clarification proposed.
Yes, in subsection 1A, they want to insert the phrase, the internet or an electronic network, including through, right after carried out over.
Making it broader.
Essentially ensuring it covers digital services delivered via any online or electronic means, future-proofing it a bit as technology changes. It just makes the scope very clear.
And something else is being deleted there, too.
Yes. Paragraph D in subsection 3 of that same section is proposed for deletion, which would modify the specific rules within that part of the digital tax framework.
Got it. Now, Section 12G, minimum tax, this was relatively new itself, wasn't it?
It was, and now there's a proposed new subsection, 3A.
What does it say?
It states, minimum top-up tax shall be payable by the end of the 4th month after the end of the year of income.
Minimum top-up tax, so an additional layer to the minimum tax.
It appears so. It introduces this concept of a top-up amount related to the minimum tax and sets a clear deadline 4 months after the year end for paying it.
So potentially another calculation for businesses subject to minimum tax, maybe ensuring a certain baseline tax payment.
That could be the aim, yes. Fine-tuning how that minimum tax system works in practice.
Okay, let's move to Section 15, deductions. Always a key area for businesses and individuals trying to reduce their tax bill. What's the big change in subsection 2?
A significant one relates to paragraph G. The existing paragraph G is proposed for deletion and replacement.
And the new one deals with?
It deals with the deduction for the decrease in value, the wear and tear, essentially of smaller items used to earn income. Things like implements, utensils, tools, items that aren't big machinery or plant covered elsewhere.
Okay, so how we account for the cost of those smaller tools.
Exactly. And the crucial change in the new proposed paragraph G is the deduction rate. It's proposed at 100% in that year of income.
Wow, 100% deduction in the same year you buy them.
That's the proposal.
That sounds like a big deal for businesses using lots of smaller tools or equipment. They could write off the full cost immediately against their income for that year.
Absolutely. It's a significant change, basically allowing an immediate full deduction instead of spreading it over time. It simplifies things for those specific assets.
Are other deductions changing there too?
Yes, the proposal also includes deleting paragraphs, I and J, in that same subsection too. So whatever deductions those paragraphs covered would be removed.
Okay, so some deductions potentially becoming more generous, others being removed entirely. It's a mixed bag.
It often is with these kinds of amendments. Now, beyond these specific sections we've unpacked a bit, Part 2 proposes a really wide range of other changes across the Income Tax Act. We can't go into every single detail, but it's worth noting the sheer breadth.
Right, just to give people a sense of the scope.
Exactly. For instance, Section 21 sees a deletion concerning gross investment receipts. Section 27 gets a new bit about what happens if the commissioner misses deadlines on applications.
Section 35, something about shipping income.
Yes, a new paragraph on income from ship owners or charterers, plus deletions of several existing subsections there. And Section 37 looks like it's getting a major overhaul regarding employee allowances and benefits.
Ah, this is often complex. What kind of changes?
It looks like they're getting much more specific about what's deductible and how benefits are valued. For example, setting specific limits, like maybe 2,000 shillings daily for subsistence allowances, or using standard mileage rates for car travel.
So less room for interpretation, perhaps.
That seems to be the goal. The proposal details how to treat company cars based on engine size and age, employer-provided housing, contributions to pension funds, group life policies, club fees, even loans to employees or directors.
And shares given to employees.
Yes, the tax treatment of those two.
Yeah.
And importantly, it proposes a clear definition of employee for these rules. It's aiming for much more precision in taxing total compensation.
Right, standardizing how you tax the perks beyond the basic salary.
Exactly. Then there are other amendments. Section 39 related to individual income. Section 52B on company self-assessment liability. Plus, the outright repeal of a few sections, 54B, 72B, and 72C.
Repealing whole sections. And it doesn't stop there, does it? Even things like information sharing and penalties.
Correct. Amendments to Section 104 on information provided under Section 101, Section 109 on failure to file returns. Section 131 is also proposed for repeal. And even the schedules, the lists at the back of the Act are being changed.
Schedules, too. Like what?
The first schedule, Part 1, which lists tax-exempt income, sees changes. New exemptions proposed for gains on property transfers in special economic zones and for securities traded on the exchange.
Okay.
The second schedule, paragraph 1, dealing with fringe benefits and qualifying interest, is amended. It introduces specific tax rates for companies certified by the Nairobi International Financial Center, tied to investment levels, holding company status, or being a certified startup.
Interesting. Specific rates for NFC companies?
Yes. And changes to other paragraphs in that schedule, including a new one setting the tax rate for fringe benefits. Even the definition of company in the 8th schedule is up for amendment.
It really is a comprehensive review, touching almost every corner of the Income Tax Act.
It is. And as you mentioned earlier, other sections dealing with pensions, management fees, interest, rent income, they're also targeted. Plus a whole raft of changes, clarifying deductions, what's allowed, what's not.
Like what kind of deductions?
Proposals touch on bad debts, capital spending, soil erosion prevention costs, legal fees, business startup costs, premises maintenance, entertainment, hospitality, vacation trips, employee dependence education, insurance, retirement scheme contributions, both registered and unregistered, advertising, research, building social infrastructure, sports sponsorships, donations, post-retirement medical fund contributions, HIF contributions, interest deductions. It's extensive.
Right. So wrapping this up, our deep dive into just Part 2 of the Finance Bill 2025 shows proposed changes everywhere in income tax, from the basic definitions to how digital services are taxed, minimum tax, personal reliefs, very specific deduction rules, employee benefits. It's a lot.
It absolutely is. The breadth and depth here really signal a potentially significant evolution in Kenya's income tax system.
And while we've tried to, map out the main areas for you, our listener, it's so important to remember this is a high-level overview of proposals.
Crucially, yes, these are proposed changes.
We really encourage you to look at the full Finance Bill 2025 yourself, get the complete picture, see how these specific proposals might actually impact your own situation, your business.
Definitely seek out the full text or professional advice if needed. Because this evolving tax landscape in Kenya means staying informed is, well, more critical than ever.
Absolutely. And maybe it leaves you wondering, with all these adjustments, what's the ultimate goal for the tax system here? And how will these changes shape the economic playing field in the coming years? Something to think about.
Part 3 of the Gazetted Kenya Finance Bill 2025.
Focusing right in on value-added tax, or VAT.
Exactly. We're going to unpack the proposals there.
And this bill, just for context, it hit the National Assembly and was published in Nairobi, May 6, 2025.
Right.
It proposes several tweaks to the current VAT Act, Cap 476.
So our mission today,
Is really to get under the skin of these amendments, not just list them out.
but figure out what they might actually mean. For businesses, for individuals, for you listening.
Precisely. Clarity is key here.
Okay, let's get into it. Starting with definitions, Section 2 of the VAT Act. What's changing?
So the main thing here is a new definition for tax invoice.
Okay.
The bill proposes adding that this term tax invoice, it specifically includes an electronic tax invoice.
The digital side.
Yes, as long as it's issued following the rules in Section 23A of the Tax Procedures Act.
So practically speaking, this just means digital records are officially okay now.
Pretty much. It's formalizing it, bringing the VAT system, properly into line with modern digital practices.
Makes sense. Everything's going digital.
It is.
All right, moving on. Section 8. This is about taxable supplies. Looks like a few interesting bits here.
Yes. Section 8, subsection 2, there's a small change, first adding the word "and" after unregistered person.
Just tidying up the language.
Seems like it, yeah. Legal precision. But more substantially, paragraph C in that subsection is proposed for deletion.
Paragraph C. Now, we don't have the exact old text in front of us, but
Yeah.
any thoughts on what that might have covered, generally?
Well, often these kinds of paragraphs, they set out specific conditions or maybe exclusions, perhaps related to certain transactions involving unregistered people, or maybe a threshold. Removing it could mean simplifying the rules or perhaps changing how those specific interactions are treated for VAT. You'd really need the original text for the full picture, though.
Understood. Okay, still in Section 8, there's another change in subsection 3B about broadcasting.
Ah, yes, this one's quite relevant today.
Looks like it.
They're proposing to replace broadcast television
Okay.
with a much wider term: internet, radio, or television broadcasting services.
Wow, okay. That's broad. So definitely not just old school TV anymore.
Not at all. This really seems aimed at capturing, well, all sorts of digital and online broadcasting.
Like streaming services, online radio.
Exactly. Video streaming, audio streaming, maybe even podcasters or content creators who monetize through those channels online. It looks like an effort to sort of level the playing field tax-wise, reflecting how media works now.
That's a big shift. Could affect quite a few players and maybe even consumers down the line.
It certainly could.
Okay, let's pivot to Section 17. This is about input tax credit. Always crucial for businesses. Several changes proposed here, too.
That's right. Section 17, subsection 5, dealing with the conditions for claiming input tax. Again, like in Section 8, paragraph C is up for deletion.
Okay, same caveat without the original text, hard to know the exact impact, but likely removed a specific condition.
Correct. And then paragraph D is being changed quite significantly. It's being replaced.
Replaced with what? What's the new rule?
The new paragraph D sets a time limit. A registered person looking for a refund of excess input tax.
Yeah.
They have to lodge that claim within 12 months.
12 months. From when?
From the date the tax became due and payable.
Okay, so a clear deadline now. Previously, was it open-ended or just different?
The text doesn't specify the before, but introducing a firm 12-month window is a key change.
What are the implications? Good or bad for businesses?
Well, it brings certainty, which is good, a defined period. But businesses absolutely need their systems sharp. They need to track input tax accurately and file within that year, or they could lose out.
Right, no room for delays.
And interestingly, paragraph E of that same subsection is also proposed for deletion. So more streamlining or adjustments to that whole input tax claim process.
That 12-month deadline really underlines the need for good bookkeeping, doesn't it?
Definitely. Efficiency becomes even more critical.
Okay, let's look at Section 31. Remission, refund, set off of VAT. It's quite a list of deletions here.
Yes, Section 31(1), which outlines the commissioner's powers on these things, it's being amended by deleting quite a few specific paragraphs. Let's see, 62, 63, 89, 91, 109, 112, 113, 128, and 129.
Wow, that's a chunk.
Yeah.
What kind of things are usually covered in paragraphs like these? Specific exemptions?
Often, yes. They might detail specific industries, situations, or types of transactions that qualify for VA exemptions, or maybe special conditions for getting a remission or a refund.
So deleting them suggests?
It could suggest a move towards a more standardized system, fewer specific loopholes or special cases, perhaps.
Making it simpler, maybe, but potentially removing benefits for some.
That's the likely trade-off, yes. But there's a transition period mentioned.
Oh.
Any exemptions that were granted under these paragraphs before the dilution happens, they'll remain valid until June 30th, 2026.
Okay, so a bit of breathing room for those affected, that's important.
It softens the immediate blow.
You also noted something specific about paragraph 89, even though it's being deleted overall.
Yes, sort of a detail within the deletion.
Right.
In paragraph 89, the phrase other aircraft spare is substituted with just aircraft. While the whole paragraph is going, this change within it before deletion might signal a change in thinking about how VAT applies to aircraft more generally, not just spares. But again, context is needed.
Interesting nuance. We also saw quick mentions of amendments to Section 42A and 47 of the Tax Procedures Act. What areas do those cover?
Right. Section 42A of the Tax Procedures Act, that usually deals with appointing VA withholding agents.
Okay, the ones who deduct VAT at source.
Exactly. So changes there might affect who can be an agent or maybe their responsibilities. And Section 47, that's generally about the process for handling overpaid tax, getting refunds or offsets.
So procedural changes likely in those areas.
Probably affecting timelines, conditions, how you actually go about claiming back overpaid VAT.
Got it. Finally, let's touch on the first schedule of the VAT. This lists supplies exempt from VAT. Looks like more deletions here.
Yes, quite a few in Part 1, which covers exempt goods. The proposal is to delete paragraphs 21, 29, 30, 31, 32, 33, 34, and 35.
That sounds like it could hit consumers directly, potentially raising prices if things are no longer exempt.
It certainly could.
What kind of goods typically end up on these VAT-exempt lists?
Usually essentials, things like certain basic foodstuffs, some agricultural produce, maybe specific medical supplies, educational materials, things considered necessities.
So taking items off that list.
Means they potentially become subject to VAT, which usually means a higher price for the end consumer unless businesses absorb it, which is less likely.
So fewer VAT-free goods potentially.
That's what the deletion of these paragraphs strongly suggests, yes, a narrowing of exemptions.
Okay, wow. So quite a range of proposed changes for VAT in Kenya then. It really seems Part 3 of this finance bill is packed with significant points.
Absolutely. From the basics like definitions and electronic invoicing through to what's taxable, especially in broadcasting.
The rules for claiming back input tax getting tighter with that deadline.
And then the reduction in specific remissions or exemptions and potentially fewer VAT-exempt goods. It's comprehensive.
Businesses and individuals really need to get familiar with these proposals.
Understanding the potential impact is crucial, yes, for compliance, for budgeting, for planning.
And if you want to see all the details for yourself, we highly recommend it. For a comprehensive understanding of all the proposed tax changes, you can download a copy of the Gazetted Kenya Finance Bill 2025. We've put the link in the description for this deep dive.
Good idea. So just to quickly recap the key VAT areas we discussed.
Please.
We saw the move to formally recognize electronic tax invoices. Changes to taxable supplies, notably broadening the scope for broadcasting services to include internet and radio.
The new 12-month deadline for claiming input tax refunds.
Exactly. Plus, the deletion of numerous specific paragraphs related to VAT remissions and exemptions, though with that transition period until mid-2026 for existing ones.
And finally, the potential shrinking of the list of VAT-exempt goods.
We also briefly noted potential changes to VAT withholding agents and the overpaid tax refund process under the Tax Procedures Act.
It's definitely a lot to digest. Understanding these potential shifts is, as we said, vital for everyone in Kenya.
It really is.
So, as you think about all this, maybe consider this. How might these proposed VA changes, if enacted, actually affect you? Your household budget, perhaps? Or your business operations next year?
That's the key question. And exploring the full finance bill beyond just the VAT section we focused on today is definitely worthwhile for the complete picture. Part 4 of the Gazetted Kenya Finance Bill 2025.
Why?
And our mission, basically, is to dissect the proposals around excise duty.
Exactly. We've got the official finance bill right here. That's our source material. And we're going to try and pull out the most important bits about these proposed excise duty changes. Think of this as, your quick guide to understanding what might be on the horizon. Okay, so Part 4, excise duty, where should we start?
Well, Section 38 of the bill kicks things off. It proposes some really crucial amendments to Section 2 of the current Excise Duty Act.
Okay.
And what's quite interesting here are the new definitions they're putting forward.
New definitions, why are those so important, usually?
Because how you define something legally, well, that often dictates how it's treated. for tax purposes especially.
Right.
So first up, the bill proposes a definition for digital lender.
Okay.
This is described as a person extending credit through an electronic medium. But, and this is the really interesting part, look at who it excludes.
Who's excluded?
Licensed banks, SACCO societies, and microfinance institutions.
Ah, so they're specifically carving out the traditional players and focusing on the sort of digital native lenders.
It seems that way, yes. It suggests they might be looking at this specific, rapidly growing segment,
Yeah.
perhaps for future excise duty considerations. It acknowledges their increasing role.
Interesting distinction. What else? Any other new definitions in this section?
Yes, there's also a proposed definition for a digital marketplace.
Okay, and how are they defining that?
It's described pretty broadly, actually. An online platform that enables users to sell goods or provide services to other users.
Online platform enabling users to sell goods or provide services. Wow, that sounds like it could cover a lot of ground in today's world.
It really could. I mean, you think about it, from the huge e-commerce giants right down to potentially smaller platforms connecting individuals, it's a very wide net.
Yeah, the scope seems massive.
Yeah.
Makes you wonder about the potential future application of excise duty there.
Precisely. It lays some groundwork.
Okay, so we've got these new definitions for digital lenders and marketplaces. What else is in Section 38?
There's also a proposed new subsection 3 for Section 2. This one focuses on how we interpret Annex 1 of the Act.
Annex 1.
Yeah.
That's the tariff book for goods, right?
Exactly. The proposal clarifies that for interpreting that annex, specifically regarding goods, we'll need to refer to the East African Community Customs Union rules.
Okay.
That includes their general rules of interpretation, which are provided in the annex itself.
So basically, for figuring out how goods are classified for excise duty, we need to align with the bigger picture EAC rules.
That's the idea. It aims for consistency, making sure the classification and interpretation line up with the established customs framework within the EAC. Makes sense for regional trade.
Yeah, that seems logical. All right, so Section 38 sets the stage with definitions and interpretation rules. Now, let's get into the actual duties, the excisable goods. The bill proposes changes to the first schedule, is that right?
Yes, exactly. The first schedule is where you find the rates of excise duty for various goods. And part 1 of the schedule is where the proposed amendments to these rates are located.
Okay, let's dig into some specifics then. What kind of imported goods might see a rate change?
Well, we can start with coal. The existing rate is mentioned as 2.5% of the custom value.
Okay, that's existing. What's proposed to change?
Right, so then we look at things like imported self-adhesive plates, sheets, film, foil, tape, basically flat shapes of plastics under several tariff numbers like 399, 9.9, 8.9, yes, or 3920.9.90, and so on. Now, crucially, this excludes products originating from East African Community Partner states that meet the EAC rules of origin.
Ah, there's that EAC exclusion again.
Yes. And for these items, the proposed new rate is 25% or 75 per kilogram, whichever is higher.
Whichever is higher. That's a key detail, isn't it?
Absolutely.
So if a shipment is valuable but light, the 25% value-based tax might kick in. But if it's cheaper but heavy, the per kilo rate could be more.
That's exactly how it works. It sets a floor based on weight if the value is low or takes a percentage if the value is high.
And that EAC exclusion seems to be a running theme.
It really does. We see it pop up repeatedly in these proposed changes for imported goods. It strongly suggests maybe an intention to favor or protect intra-EAC trade compared to imports from elsewhere.
Makes sense. What other imported goods are looking at potential rate adjustments?
Okay, next up we have imported float glass and surface ground or polished glass in sheets that's under Tariff 7005. And again, same story, excluding those originating from EAC partner states that meet the rules of origin.
And the proposed rate for this class?
It's proposed as 35% of custom value, or KSH, 200 per kilogram. Again, whichever is higher.
Wow, 35% or 200 shillings a kilo. That's quite a jump, potentially. Glass is used everywhere, construction, manufacturing.
Absolutely. This could have some pretty wide-ranging effects. Businesses relying on imported glass from outside the EAC would really need to factor this potential cost increase in.
Definitely something to watch. Okay, what about paper products? Are there proposed changes there too?
Yes, several categories of imported printed materials are also targeted. For instance, printed paper or paperboard under tariff headings 48811.41.90 or 4811.49.00.
With the EAC exclusion, I assume.
You got it. Excluding EAC origin goods meeting the rules. The new proposed rate here is 25% or KSH 150 per kilogram, whichever is higher.
Okay, so 25% or 150 shillings per kilo. That whichever is higher clause is definitely standard practice in these proposals.
It seems to be the preferred mechanism, yes.
And does this trend continue for other imported printed stuff?
It does. There's then a whole raft of other imported printed materials listed. This covers various types of plastics, like polyethylene terephthalate, under a really extensive list of specific tariff numbers. Uh-huh.
A long list.
A very long list. We probably don't need to read every single number, but they cover tariff headings like 3920U, 3921, 3926, 3919, and many specific subheadings within those.
Right.
For all of these, and again, excluding qualifying EAC origin goods, the consistently proposed rate is 25% or KSH, 200 per kilogram, whichever is higher.
Okay, so a standard rate across a wide range of these imported plastic and paper-based printed items. That's a lot of different materials potentially affected.
It is. It really suggests a deliberate move to adjust the excise duty structure quite broadly for these types of imported goods.
Yeah, seems like a clear focus area.
And there are a couple more specific paper items mentioned, too, following the same pattern.
Go on.
Like imported printed cellular of other plastics under tariff 321.19.90, same proposed rate. 25% or KSH 200 per kilogram, whichever is higher, with the EAC exclusion.
Okay.
And then printed paper under 4888.41.90 again. And gummed paper and paperboard under 4811.49.00. Both proposed at 25% or KSH 200 per kilogram, whichever is higher, excluding qualifying EAC goods.
So that 25% or cash 200 per kilo rate seems quite common for these various plastic and paper imports.
It certainly does. It appears to be the go-to rate for many of these categories in this proposal.
Now, for our listeners who really need the nitty-gritty, those specific tariff numbers are all listed in the official finance bill itself, which they can check out.
Absolutely, yes. The bill has the full detail.
But the main takeaway seems to be that consistent proposed rate structure and that recurring EAC origin exception.
Precisely. Those are the key patterns to notice across these numerous categories of imported goods.
Okay. Was there anything else significant in the first schedule amendments you noted? You mentioned spirits earlier.
Yes. The schedule also lists spirits of undenatured extra-neutral alcohol, specifically the high-strength stuff over 90% alcohol when it's purchased by licensed manufacturers for making spirituous beverages.
And the rate for that.
The existing rate is stated as liter 500 per liter. Now, in the section we're looking at, there isn't an explicit proposed change mentioned for this specific rate, but it's listed as part of the current schedule structure being amended.
Okay, so noted as existing, maybe no proposed change there in this specific part of the amendment text. Got it.
Right.
So let's try and summarize the key excise duty proposals in Part 4 then. We've got new definitions for digital lenders and digital marketplaces. That seems significant for the future.
Definitely sets the stage.
And then several revised rates, focusing heavily on a range of imported goods, particularly plastics, glass, and various paper products.
Correct. With that consistent whichever is higher mechanism for many of them.
And that all-important exclusion for goods originating from within the East African community, provided they meet the rules of origin. That's a big recurring element.
It is indeed a very significant aspect of these proposals.
So these amendments, if they go through and become law, could really have quite considerable implications, couldn't they?
Oh, absolutely. Particularly for businesses involved in importing those specific goods we discussed, and potentially down the line for those operating in the digital lending and marketplace sectors, given the new definitions.
So the bottom line is, if your business deals with importing plastics, glass, or printed materials, especially if you source them from outside the East African community,
Yes.
you really need to be paying close attention to this and digging into the details.
Without a doubt, understanding how these potential changes might hit your costs, maybe influence your sourcing decisions, and just your overall business planning, that's going to be essential.
Okay, well, this has been a really focused deep dive into just the excise duty proposals within the Finance Bill 2025. There's obviously much more in the full bill.
Much more, yes. This is just one part.
So to see all the specifics, all those tariff numbers, and understand the full context of the entire bill, we really have to encourage you, the listener, to download a copy.
Please do.
Get the Gazetted Kenya Finance Bill 2025. We've put a link for you right in the description below this video.
And looking at these excise duty proposals specifically, it does raise a broader question for you to think about, doesn't it?
What's that?
How might these potential shifts, ripple through different parts of the Kenyan economy? How might they ultimately influence the cost or availability of goods and services that you encounter every day?
That's a great point. It's not just about the direct tax, but the knock-on effects.
Exactly. So examining the full bill really allows you to start forming your own informed conclusions about those potential impacts. Tax procedures. Maybe not the most thrilling topic usually, but super important, right?
Absolutely crucial. And things might be changing with the Kenya Finance Bill 2025.
Yeah, exactly. So today we're zeroing in, doing a real deep dive specifically into Part 7 of that bill. That's the bit that deals with tax procedures.
Right. Think of these procedures as like the operating system for taxes. Part 7 is looking at tweaking the main law, the Tax Procedures Act, Cap 469B. And these changes, well, they affect how taxes get collected, how the KRA works, and importantly, how you interact with them.
Okay, let's get into it. Our source for this is the official gazetted Kenya Finance Bill 2025. It's pretty dense stuff.
It definitely is.
So our mission here is to pull out the key nuggets, the really important proposed changes in Part 7. We want to give you clarity on what might be coming down the line without you needing to wade through the whole legal document yourself.
Precisely. We're focusing on the shifts that you'll likely notice most, the ones affecting taxpayers and the day-to-day running of the tax system.
Right. So Part 7, where do we even start? There seems to be quite a bit in there.
Let's kick off with something very current, electronic tax invoices. The bill wants to amend Section 23A, basically to formally recognize and define these e-invoices.
Right, invoices, yeah. Seeing those everywhere now. So what's the main change? Is it just making them official?
It's a bit more than that. It's about standardizing things.
Mm-hmm.
Interestingly, it also lists things that might not need this specific type of electronic invoice under subsection 3.
Oh, like what?
Well, things like salaries, emoluments, import costs, interest payments, certain accounting things for investment allowances, airline tickets, and also payments where withholding tax is the final tax. So it's not like every single payment needs this exact format.
Got it. So some carve-outs. And who's building this electronic system? KRA.
The bill gives the commissioner the power to set up and run an electronic system specifically for issuing and recording these invoices. So yeah, it points towards a central official digital platform.
Okay. And if I get one of these official e-invoices, what information has to be on it? Sounds like it needs to be pretty thorough.
Oh, it does. The proposal, subsection 2A, lays it out clearly. It must say tax invoice right at the top. Needs the supplier's details, the buyer's details, name, address, PIN, a unique serial number, the date and time, exactly what was supplied, goods or services, quantity, type.
Wow, okay.
And any discounts, the cost, the tax rate, the total tax, plus anything else they might prescribe later.
Yeah.
It creates a really solid audit trail. If you're running a business, your systems need to capture all this.
And this becomes the main document for tax purposes.
If you're a resident or a non-resident with a permanent setup here, and you're meant to use this system. Yes. An invoice from the commissioner's system under subsection 1 is basically the record for sorting out your tax liability for that specific transaction. It really pushes people towards the official channel.
Makes sense. But what about the smaller players, small businesses, maybe farmers? Do they have to jump onto this complex electronic system straight away?
That's a key practical point. And yes, the bill includes an exemption. If you're a small business or a small-scale farmer and your annual turnover isn't more than 5 million shillings,
okay,
then you don't have to issue invoices through this specific electronic system. You can use other methods. It seems like a nod to the fact that, adopting a full digital system can be tough for very small operations.
Right, that sounds reasonable. Okay, moving on. Amended assessments. Section 44 talks about changing assessments.
Yes, it amends Section 31 of the main act. This is about when the commissioner can revisit and change an original tax assessment they made or one you submitted yourself.
And are there time limits on that? How far back can they go?
The general proposal is this. For a self-assessment, the commissioner can amend it within 5 years after you filed your return. For any other kind of assessment, like one they issue to you, it's usually within 1 year after they sent you the notice. It's whichever date is later.
5 years or 1 year?
Yeah.
Okay, but are there exceptions?
Big ones. If they find evidence of, and the wording is specific, gross or willful neglect, evasion, or fraud by you or someone acting for you, then that time limit, it's gone. They can amend the assessment pretty much any time. And even in other cases, they still have up to 5 years to make further amendments, even if that initial 1-year window passed. So keeping good records is vital.
No kidding. And if they do amend my assessment, what do they have to tell me?
They need to notify you clearly. The notice should state the new amount assessed, any penalty, any interest charged, which tax period it relates to, the new payment deadline, and crucially, how you can object if you disagree.
Okay, good to know the process. Now, penalties. Section 45 mentions penalties for not deducting or withholding tax.
That's right. It amends Section 39A. Basically, it introduces a penalty if you're supposed to deduct or withhold tax when you pay someone, but you failed to do it, or failed to send it to KRA.
Seems straightforward. But hang on, what if the person I paid, maybe my supplier, actually went and paid that tax themselves later? Do I still get hit with the penalty and have to pay the tax I failed to withhold?
This is an interesting point in the proposal. It says you won't be required to pay the principal tax, the actual tax amount you didn't withhold, if the person who received the payment has already paid and accounted for that full principal tax.
Oh, okay. So it avoids double paying the same tax. That seems fair.
It seems aimed at preventing that, yes. Though penalties might still apply for the failure itself, just not the principal amount in that specific case.
Right. Got it. Next up, Section 46, security on property for unpaid tax. This sounds, well, significant.
It is. It amends Section 40. This lays out a process where if you haven't paid your tax by the due date, the commissioner can basically put a legal claim or hold on your property, like a lien.
How does that actually work in practice?
The commissioner can write to the relevant registrar, think land registrar of motor vehicles, telling them your property is subject to a security for the unpaid tax. The registrar then has to record this notice, usually without charging a fee. And once that's registered, it acts as a legal block, stopping you from selling or transferring that property.
So it secures the debt for KRA. Can they then sell my property?
They can. But first, once the tax is secured, maybe you offer another form of security or pay up. The commissioner can write to the registrar again to cancel the notice. However, the proposal also states that the commissioner can, after giving you proper notice, actually dispose of, meaning sell the property that's under restraint to recover the tax owed.
Wow. Okay. And what counts as property here? Just land? And who is this registrar?
Property is defined pretty broadly. It includes land, buildings, aircraft, ships, cars, or really any other asset the commissioner thinks is enough security for the tax debt. And registrar covers various officials: land registrar, registrar of ships, aircraft, motor vehicles, and basically anyone else legally allowed to register a property security for unpaid taxes.
Okay, clear. Let's shift gears slightly. Section 47, power to collect tax from someone owing money to a taxpayer. What's this about?
This amends Section 42. It gives the commissioner the power to go directly to a third party. The law calls them an agent who owes you money or holds money for you or might owe you money in the future.
Wait, so if I owe taxes and my client owes me money for a job I did, KRA could tell my client to pay them instead of me?
That's essentially it, yes.
Right.
The commissioner can issue a notice to that agent, your client in this example, requiring them to pay the money they owe you directly to the commissioner, but only up to the amount of your outstanding tax debt.
That could get complicated. Are there situations where they can't do that?
The bill does say the commissioner shall not issue such a notice under certain conditions.
Yeah.
However, the specific details of those conditions, those exceptions, they aren't actually spelled out in the excerpts we're looking at here. You'd need the full text to see exactly what those limitations are.
Okay, fair enough. Something to watch out for. Next, Section 48, appointing VAT withholding agents.
Right. This amends Section 42A. The proposal allows the commissioner to appoint specific people or companies to act as VAT withholding agents.
What does that mean they have to do?
When these appointed agents buy taxable supplies from someone, they'd have to withhold 2% of the taxable value at the time they pay the supplier. And then they remit that 2% directly to the commissioner.
So another collection point, basically. The buyer helps collect the VAT. Does this apply to everything?
No, there are important exceptions. It wouldn't apply to supplies that are zero rated for VAT. Also, it seems large manufacturers are excluded, specifically registered manufacturers whose investment value was at least 2 billion shillings by the end of December 2024. And the commissioner can also revoke someone's appointment as an agent. Oh, and it also doesn't apply to supplies for official aid-funded projects.
Got it. And quickly, Section 49 mentions digital service tax agents.
Yes, briefly. It proposes amending Section 42B to allow the commissioner to appoint agents for collecting and remitting digital service tax as well. It just reflects the growing digital economy, you know?
Makes sense. Now, what if you paid too much tax? Section 50 talks about offsets or refunds.
Yes, amending Section 47. If you've overpaid tax, the proposal says you can apply to the commissioner. You have two options. Either ask for the overpayment to be offset against other taxes you owe, or ask for a straight refund.
Is there a deadline to apply?
Yes, and it's different depending on the tax. For income tax overpayments, you have 5 years from the date you overpay to apply. For other taxes, it's a much shorter window, only 12 months. So you need to be on the ball if you think you've overpaid something like VAT.
Right, 5 years for income tax, 1 year for others, and what happens after I apply?
The commissioner is supposed to check your application, ascertain if there really was an overpayment, and determine the amount. If confirmed, they can then apply it to your other tax debts or refund the cash to you.
Okay, now, what if I disagree with a decision KRA makes? Objections, Section 51.
Yes, amending Section 51. This is a really crucial procedural point. The proposal makes it clear. If you want to dispute a tax decision, you must first lodge an objection directly with the commissioner.
Before going to court or anything.
Before proceeding under any other written law, yes. You have to file this objection within 30 days of being notified of the decision you disagree with. So it's a mandatory first step. The commissioner gets the first review.
Does it say what needs to be in the objection to make it valid?
The specific requirements aren't detailed in this excerpt, but typically you'd need to state clearly why you object and provide supporting info. The key thing is, once you lodge it properly, the commissioner has to consider it and make an objection decision.
Okay, deadlines. Section 52, due dates for submission and payment. Anything changing there?
A practical clarification, really, amending Section 77. It says if your tax return deadline or payment due date falls on a Saturday, Sunday, or a public holiday in Kenya,
Yeah.
then the due date effectively shifts. It becomes the previous working day.
The previous day, so not the next Monday, but the Friday before.
Exactly, the previous working day. So you need to plan ahead a bit.
Yeah.
If a deadline falls on a weekend, it's meant to avoid confusion, I think.
Huh. Okay. But is there an exception? I thought I saw something.
You did. There's an exception specifically for people submitting objections electronically or paying tax electronically. For those electronic transactions, the original due date, even if it's a Saturday, Sunday, or holiday, still applies, presumably because those systems are always on.
Right, that makes sense for online stuff. Okay, nearly there. Penalties ends, Section 53. This time for late filing or not filing returns.
Yes, amending Section 83. This section details the penalties if you submit your tax return late, or just fail to submit it at all. The proposal specifies different penalties for different types of returns.
Like income tax versus VAT.
Exactly. There are specific penalties laid out for late income tax returns, turnover tax returns, and VAT returns. It also mentions a penalty if you fail to submit some other required document, not a tax return, by its due date. It's all about encouraging timely compliance.
Are these fixed fines or based on the tax?
It seems to vary. For instance, income tax penalties might be a percentage of the tax due or a fixed amount, whichever is higher. VAT might be different. The bill aims to set out these structures clearly.
And Section 54 just clarifies penalties are separate.
Yeah, amending Section 89. It basically says each penalty under the different sections is calculated on its own. You don't just lump them together.
And finally, Section 55, failure to comply with notices.
Right, amending Section 109. This lists various things that count as an offense if you fail to follow official notices, requests for information, or other requirements under the Tax Procedures Act. Things like not providing documents when asked, not attending a meeting with the commissioner when required, stuff like that.
Okay, wow. That was a lot, but really useful. So to quickly recap, we've looked at the proposed changes in Part 7, covering electronic invoices becoming more formalized, the rules around amended assessments and those crucial time limits, penalties for not withholding tax, but with that interesting caveat about double payment.
The power to secure unpaid tax using property, collecting tax directly from people who owe taxpayers money, the new VAT withholding agent system at 2%, with its exceptions, the mention of digital service tax agents.
How to claim refunds or offsets for overpaid tax within specific timeframes, the absolute requirement to object to the commissioner first if you dispute a decision, the change to due dates falling on weekends or holidays moving to the previous working day unless you file electronically.
And updated penalties for late or missing returns and failing to comply with other official requests. It's quite a sweep of procedural adjustments.
It really is. And while maybe not as flashy as tax rate changes, these procedures, as you said, are the engine room. They directly affect how businesses and individuals deal with their tax obligations daily. Understanding these proposed changes is, well, It's essential to stay compliant and just navigate the whole system.
Definitely. Knowledge is power here.
Absolutely. So if you want to dig into the precise legal wording yourself, we really encourage you to download the full gazetted Kenya Finance Bill 2025. We've put a link right there in the description for you. Pay special attention to Part 7, obviously.
And maybe leave you with a final thought to chew on. As Kenya moves more towards these electronic systems, e-invoices, e-filing, potentially more digital interactions, how do you think this will actually reshape the whole taxpayer experience? Will it make things more efficient? Fairer? What role does having these clear procedures play in building trust between taxpayers and KRA?
Part 6, that's the section on miscellaneous fees and levies.
Right. Sounds a bit dry, maybe. Miscellaneous fees.
It can sound that way, but honestly, this stuff often gets overlooked, and it can tell you so much about where things are headed, economically speaking.
Exactly. While everyone's eyes are on, say, income tax rates,
Mm-hmm.
these specific levies and fees, they often hit particular sectors or activities. So our mission today is basically to unpack these, try and figure out what they actually mean for businesses and, well, maybe for you.
Yeah, give you some clarity on these less talked about bits. So look, if you really want to follow along closely, we strongly suggest you download the gazetted Kenya Finance Bill 2025 yourself. We've put a link right there in the description.
Definitely worth doing if you want a full picture.
Okay, let's get started. Part 6. It kicks off with an amendment to Section 9B of the Miscellaneous Fees and Levies Act. What's happening here?
Well, the first thing you notice are a couple of deletions. They seem small, maybe just editorial, but they're interesting.
Oh, like what?
Okay, so first, in the little summary note at the start of Section 9B, the marginal note, they've taken out the words to excess tax refunds.
To excess tax refunds, gone. Okay.
And then a bit further down in subsection B, they've removed the phrase provisions of Section 47 of the...
You're right, just sniffed out. So why do these little word changes matter? What could they signal?
Well, in legal texts, wording is everything, isn't it? Removing to excess tax refunds from the description might suggest maybe a broader scope for this section now. Or perhaps they want to handle all tax refunds more uniformly elsewhere, not single out excess ones here specifically regarding fees.
So maybe simplifying or tidying up how refunds are dealt with across different laws?
Could be. It might be about streamlining how this act talks about tax adjustments in general. Removing the specific reference to Section 47 could also point towards maybe consolidating rules or avoiding potential conflicts between different sections. It's subtle, but potentially cleans things up.
Okay, makes sense. A bit of legislative housekeeping, perhaps, but with potential flow-on effects. Let's move to the second schedule, then. This seems more direct, changing things for specific goods. Part A first.
Yes, Part A. So here, paragraph is deleted entirely. That paragraph was about other articles of iron or steel.
Okay, iron and steel out.
And it's replaced by a new paragraph. Eric?
And this new paragraph, it's quite different, isn't it? We're suddenly talking about, what, planes?
Exactly. The new paragraph lists all parts of Chapter 88 and goods of tariff heading 8802.3000 and 8802.400000.
Huh?
Now, Chapter 88 in the customs tariff system, that's basically everything that flies. Aircraft, spacecraft, helicopters, and all their bits and pieces.
Okay.
And those specific tariff codes, 8802.3000 and 8802.4000, they cover helicopters and other powered aircraft heavier than air ones.
So it looks like miscellaneous fees or levies under this act are now explicitly being applied to the aviation sector, specifically these types of aircraft and their parts.
Seems that way. It's a definite shift in focus.
Why now, do you think? Any ideas on what's driving this?
Hard to say for sure without more context, but you could speculate. Maybe it's about generating revenue from a growing sector, or perhaps aligning with international practices for aviation charges. Could even be related to specific infrastructure projects. But the main point is aviation parts are now clearly in the scope here.
Right, a clear signal. Okay, now Part B of that same second schedule looks like a similar move.
It does, yeah. Paragraph 13 is deleted. That one covered things like wire mesh, fencing, reinforcing fabric. Basically woven stuff made of iron or steel.
So more steel products removed from this part.
And replaced again, this time with a new paragraph.
Let me guess. Aviation.
You got it. The new paragraph also brings in all parts of Chapter 88 and goods of tariff, heading 8802.00000 and 8802.4000.
Wow, okay, so they're really doubling down, putting these specific aircraft and parts under the miscellaneous fees scope in two different places in this schedule.
It really reinforces the point, doesn't it? The very clear, targeted inclusion of these aviation items.
Definitely something for anyone involved in that sector to note. Okay, let's switch gears to the third schedule. This one deals with the Export and Investment Promotion Levy. Looks like quite a bit of activity here, changes to existing stuff and some new things being added.
Yes, exactly. The third schedule sees adjustments to levy rates for some items already listed, and then, yes, some brand new categories being brought under this levy. Let's look at the rate changes first, particularly for iron and steel.
Okay, what do we got?
First one is semi-finished products of iron or non-alloy steel, specifically low-carbon ones, with a certain rectangular shape. The levy rate on these is dropping
Dropping from what to what?
from 17.5% down to 10%.
Okay, that's a decent drop. And just quickly, what are semi-finished steel products again? Like ingots?
Sort of. Think basic shapes like billets or slabs. They've been initially processed but need more work, like rolling or forging, to become finished goods like beams or sheets. It's an intermediate stage.
Got it. So a lower levy on those. What else?
Similar reductions for bars and rods of iron or non-alloy steel, hot-rolled in irregularly wound coils. There are two categories mentioned based on diameter, basically under 14 millimeter. Both of these also see the levy drop from 17.5% to 10%.
And these bars and rods, that's like rebar for construction.
That's a primary use, yes. Reinforcing concrete, also used in manufacturing for various components. The coils part is just how they're often shipped.
Okay, so across these key steel products, semi-finished and basic bars rods, the levy is being cut quite significantly. What's the likely strategy behind this?
Well, it looks like a move to make Kenyan steel production more competitive, doesn't it? Lowering an export-related levy could encourage more local production, potentially attract investment in steel manufacturing, maybe make exports cheaper, or support downstream industries that use this steel. It feels like part of an industrial strategy.
Trying to give the local steel sector a boost makes sense. But it's not all reductions, is it? There are new things being added to this export and investment promotion levy, and targeting imports this time.
That's right. A whole swath of new items, specifically imported ones, are now subject to this levy. First up, various imported other self-adhesive plates, sheets, film, foil, tape, strip, and other flat shapes of plastics under certain tariff codes.
Self-adhesive plastic, so like sticky tape, labels, plastic wrap.
Pretty much, yeah. Things used in packaging, labeling, maybe some industrial applications. And importantly, this levy doesn't apply if the goods come from within the East African community.
Ah, the EAC exclusion. That's interesting. And the levy rate.
It's 25% or shash,
Yeah.
75 per kilogram, whichever's higher. That whichever's higher part is key.
Yeah.
It sets a minimum charge based on weight, even if the value is low.
Right. So potentially making imports from outside the EAC more expensive, encouraging regional trade or maybe local production.
That seems to be the logic. And we see the same pattern for a bunch of other imported printed materials.
Oh, yeah. Like what?
Okay, there's imported printed polymers of ethylene, vinyl of chloride, polyethylene of terephthalate,
Yeah.
also printed cellular plastics, plus specific types of printed paper and paperboard and gummed paper and paperboard. Again, all these exclude imports from EAC countries.
And the levy on these?
It's even higher on the per kilo basis. 25% are KSHs, 200 per kilogram, whichever is higher.
Wow. K-HOTS. 200 per kilo minimum. That could significantly impact the cost of imported printed packaging, labels, flyers, lots of things, right?
Absolutely. Businesses importing these finished printed materials or materials for printing locally from outside the EAC will likely face higher costs. And you have to wonder if that will eventually be passed on to consumers.
Seems likely. It's a strong signal towards either sourcing within the EAC or developing more local capacity for this kind of printing and material production.
Precisely. And there's one more significant addition.
What's that?
It's on alcohol. Specifically, spirits of undenatured extra-neutral alcohol. Very high-proof alcohol, over 90% when it's bought by licensed manufacturers of spirits here in Kenya.
So the base alcohol used to make gin, vodka, that sort of thing.
Exactly. That now gets a levy of kush, 500 per liter.
Gosh, 500 per liter. That sounds like it could add a noticeable cost to producing spirits locally.
It certainly seems like it would increase the input costs for local distilleries, yes. Which again raises questions about the final price of those locally produced spirits on the shelf.
Could make imported spirits relatively more attractive or just increase prices overall. Okay.
So quite a mix of changes in that third schedule. Lowering levies on some basic steel inputs while adding potentially significant levies on imported plastics, printed materials, and the base alcohol for spirits.
Right. So let's try and wrap up this deep dive into Part 6, the miscellaneous fees and levies section of the Finance Bill 2025. We've seen, well, those subtle tweaks around tax refund language in Section 9B.
Then the quite clear shift in the second schedule, bringing specific aircraft, helicopters, powered planes, and their parts under the scope of these fees.
And then in the third schedule, a real mix, reducing the export and investment promotion levy on some key iron and steel products, potentially boosting local industry.
While simultaneously introducing new, sometimes quite hefty, levies on imports like certain plastics, printed paper and plastics, and that crucial extra-neutral alcohol for spirit makers. Remember those EAC exclusions, too.
It really highlights how these miscellaneous items aren't minor at all, is it? They can have very targeted impacts across different industries: aviation, construction, manufacturing, printing, beverages.
Absolutely. And their collective weight can influence trade flows, production costs, investment decisions, and ultimately consumer prices. It's not just about the big tax rates.
So it leaves you thinking, doesn't it? How will these specific changes play out? Will the lower steel levies genuinely boost exports? How will industries reliant on those imported plastics and printed materials adapt? What happens to the cost and competitiveness of locally made spirits?
And maybe that's the final thought to leave you with. It really pays to look beyond the headlines, doesn't it? Digging into these details, these miscellaneous fees and levies, gives you a much richer picture of the economic currents and policy directions.
Absolutely. So we encourage you, again, if you're interested, grab the full finance bill. The link's in the description. Have a look yourself. See what connections you can draw. It's always worth taking the deep dive.